price of a company. And so we'll get into all that, especially when we talk about Warren Buffett and Benjamin Graham in a week or two from now. But today we'll talk about what's creative destruction. What is that to you so far? So if I told you right now, well, let's first start. Who's heard of Joseph Schumpeter before this class? Raise your hand. Nobody? Okay, good. That's why we're here. All right. So, and what about the concept of creative destruction? What are you sort of sussing out there, at least for now?
Kind of like because like I've heard it like phrased of like the art of creative destruction in a way. So it's like in a way it's like you almost kind of have to destroy certain inventions to try and like innovate to something else that might potentially or should be greater than what was last made, kind of thing.
Right. So destroy maybe markets or businesses or even growth models, all these things. All right. Anybody else want to take a stab? I like that sort of. It's in the vicinity. Anybody else? Creative destruction. Okay. All right. So we already did the recap, by the way, if you're following along. All right. So how about this? How about equilibrium theory versus business cycle theory? This is like a step back from the concept of creative destruction. Just one step back from that. It's a concept that Schumpeter really did a lot of work on here. And what's equilibrium theory in economics?
Where you can find the balance of profit and cost.
Right. So it's like that balancing point or that fulcrum where everything kind of just settles into place. So price meets demand, and then the world is complete. Right. Does the market work this way? Or no? Do things just settle nicely and then we can move on? Or no, into like an equilibrium? A nice, comfortable, like balancing point, or no? Or do things work in a cycle, ups and downs more? This is the second point. What do you guys think? Who would say the first one? The economic, the classical economic way or neoclassical equilibrium model. Actually, it's not really the first economic model. Actually, the original ones were more political economy based, and we're looking at markets more as dealing with a series of ups and downs. But you have this neoclassical model that says markets come to a sort of nice balance. What about the business cycle theory? What's that? If that's the first one saying that it comes to a balance, what's the second one saying?
It like goes through different stages repeatedly.
Right. Over and over again, right? And so what happens if you were to say, if businesses were, let's say, propped up through these cycles, would that make sense to do that? Or like to give money to bail out businesses while they're going through this up and down? Would that be the right approach, do you think? Or what would it do? And so this is the sort of the notions that we're dealing with when we're talking about Joseph Schumpeter, the idea of creative destruction and business cycles. So what would it do? Would it cause any downsides if you're saving businesses from failing? What would it do for you? What do you think? Again, we'll have time to get to that, but I just want to hear your thoughts of it. So take a stab at it. I know it's early. It's still 11 a.m.
Like I think if you like bail out of businesses going bankrupt, it has the potential to like give them a boost. But at the same time, like because it's a cycle, like when they make their way back around to where they started, like let's say if they don't have that loan opportunity again or whatever it may be, like they're gonna drop even harder than they did initially. So
Okay.
I guess you'd say like initially it would be a positive impact, but it could also be negative if the business doesn't make the most of that.
And then who draws the line on which businesses get to survive, which ones don't? what scenario is it okay for a business to get help from the government or Uncle Sam or whatever, and which ones are not okay. So who picks the winners and losers? Is that a problem as well? All right. And just to stop, because I'm getting into another area, Schumpeter, a lot of Schumpeter's work, well, he's an Austrian, very pro-market. What he's doing is he's reading, this is how Schumpeter becomes famous. He's actually reading the work of Karl Marx. Everybody know Karl Marx? He's a communist, anti-capital. If anybody's, I don't know if you could say he created the idea of markets going into chaos. But what Schumpeter does is he tries to give the pro-market side or pro-market argument. So he goes and rebuts every point, or at least the points he found interesting within Marx's work. So you get what I'm saying? So this is what Schumpeter does. And so I said that because I said, should we be helped? Because I'm going to do something maybe a little bit like take a brief divergence here. Should we be helping businesses that failed or that did the wrong thing or just weren't adapting to the market's demands, or should we just help people if we're more afraid of like people losing their jobs or homes? Could we have then just safety nets for people when businesses do need to go bust and clear it out, right, and get some new businesses to grow in? That's the idea of business of the business cycle. There's just its natural flow of markets to have periods of booms and busts that we'll see here. So again, to define the business, but I wanted to lay down some theoretical and rhetorical musings for you to sort of start thinking about these things. And hopefully it makes sense to you. Again, because it's a little bit of, we're getting into the theoretical side of why you should let businesses fail. Again, so the business cycle refers to a wave-like fluctuation in the overall level of economic activity. And so what are some of the things that could fluctuate? It's going to be the national output. You can measure this by GDP. Income of people, employment could fluctuate as well. So, businesses start to bleed employees. They don't want to carry them anymore. Prices could go up or down. And so we're seeing this like in the housing market, record housing prices. The stock market is at record highs as well. People are wondering if there's value there. Again, we're going to go back to Warren Buffett later and discuss what define value a bit more clearly for us. And so it's basically the natural ebbs and flows of the market. That is the business cycle. The business cycle looks a lot like a stock market chart. It doesn't look like an X, which is an equilibrium, right? It looks more like the stock market. This is how you should see it. So if I put up a chart of the S&P, it should resemble this. There's expansion periods, there's boom periods, there's an inflection point, then there's recessions and depression. Is it a clean function, and can you predict though? Because it looks like there's parabolas here, and that you might be able to use calculus to sort of predict the next business cycle, but they're unpredictable, actually, very unpredictable. They're hard to predict. If not, most of us business scholars would focus on understanding these functions and become millionaires and move on with our lives. But sadly, that's not the case. So, marginal analysis, using calculus to try to understand the financial flows doesn't work. But in any case, this is what the business cycle looks like. This is from April, so this is an older one here, but you see where we're going. What's the S&P at now? This is from April of this year, I believe. Where are we at now in the S&P index? Anybody think, guys?
On your thing right here, like I think you've updated it. It looks like from September 5th, it's at 6,400.
Yeah, so it's
65.
changed. Yeah, and I'm on a different slide deck. Okay, so that's okay. Of course, I knew I'd do something wrong. Let me see. Well, let me try to pull up the good one.
That's 65.
Yeah. 6,500. But it's good because at least leaving it up there shows just how we're ratcheting things up. Let's see here. Take modified. I think it's this one. If not, we'll just go with it, but I'd like to just go, let's go with the newest data, the newest stuff I've got here. Let's do that. Here we go. Love it. I always save copies of things just because the on the pen drive, these things sometimes get corrupted and all that. So I always have like a backup of a backup. Anyhow, so yeah, so now we're at 64.81. This is from September 5th. So we're breaking all-time highs. Oh, and I have some notes here. I did have this older one here. So if we look at what happened here at the 52-week high, we were at 6,500, and now we had a 52-week low at 4,800. So what's going on? What are we seeing here? Anything? What's this 30% drop almost, right? I put a little note here at the bottom. There's a 26% drop just a few months ago. So what is going on in the market? It is wacky. Okay, and then we're seeing it shoot back up. So around April, we had this decline, and over the summer, and now we're shooting back up. So very interesting things. Again, the key point to take away for now is that the S&P 500, the way the economy works, looks a lot like a business cycle or the cycle theory of markets rather than any sort of equilibrium. What would this chart look like if markets just reach an equilibrium? I like that. What were you doing? You were going
I'm
like,
just going like
yeah,
that.
flat. And in other words, what would it be? Would it be a market or would it be dead? It would be stale, right?
Yeah.
All right, so that's another thing. So things need, just like in life, if we're going to have a free market, things need to die and things need to be born or grow, right? Or flourish. So we need to allow that to happen. What are we doing by saving these companies? We're preventing others from growing, right? That are naturally just better at things. And we're also encouraging bad behavior as well. It's called moral hazard. It's this idea that taking on risk is acceptable and worthwhile, and being reckless because you know you'll be your mom or dad or something are going to come save you, or somebody's going to come save you, and you could just behave badly and poorly and nothing will happen. And so it's not good for the consumers, it's not good for employees, and so it's reckless behavior. And so that, anyway, so that's just the general gist there. If we're going to drill down a little further, we could drill down in terms of like, what do these three phases mean, right? And so an expansion is going to be defined as net positive GDP growth, or when the economy is nearing full employment. That means that anybody that wants a job can get a job. It's a job, not exactly the dream job, but if you need a job, you'll get a job. You just need to apply. Contraction or downswing, these are recessions. These are short-term contractions. The definition of a depression, a pretty well accepted one, is recession lasting 2 years or more, or GDP loss of greater than 10%. So we haven't exactly had a GDP loss of greater than 10%, but we have been in a decline a bit since 2024, I believe. It's the latest the Federal Reserve is discussing now. Since 2024, I think April of 24, we've been sort of on the way down a bit. So we're not exactly in a recession, but they are starting to try to grapple with reality a bit more. But and then so what do they do? So if you're talking about, I think we talked about monetary policy. Do you lower interest rates? Do you raise interest rates? Again, interesting questions. But perhaps right now we'll have a talk on the bond market where we could get into that more as well. But for now, we'll just focus on this. And so what are some of the things that could affect or move business cycles in certain directions? Well, there's material factors in the market. There's also ideational factors that are part of the market, ideas, fears, bullishness, sentiment. Everybody's heard of these terms, right? Bullish sentiments. What's the other term? It starts with the B, huh?
Bearish.
Yeah, bearish. Like our bear here, Briscoe, will come in the room, and then everybody runs. from the market, sell. All right. Is it Briscoe his name? The bear? Bristico?
So,
I think there's a pizza shop named Briscoe's too down here. Has anybody been to that one? They have an ice cream. Is it Briscoe's? I don't know. I'm getting them all confused. They have pretty good pizza.
Briscoe.
Briscoe's? Is it Briscoe's? Okay. Yeah, I like their pizzas. I do like Emma's and the Cape Cod style, but they get a little greasy for me. Sometimes they get a little.
They better.
Yeah, Briscoe's is okay. All right. Anyway, getting back to this. So then you have non-market factors. These are things like politics. We'll get into these in a second. So again, business growth for material. Think of a new industry, a new trade, etc. Also, think of things like underconsumption, deflation, or even inflation in terms of overconsumption. We'll look at things like the Baltic Dry Index. Here's a link to that and who knows what the Baltic Dry Index is?
Is that like the kind of like the way they?
Oh yeah, but you're cheating. Wait, because you're in my
Yeah, but I know. So I
you're
know.
in my 355 management class. So hold that thought. Let's see. Anybody else? Okay, take it away.
So it's kind of like the kind of way they go about selling like the market and international ship cargo travel. So with like grain, salt, stuff. All
Right. They're looking at dry good products, beans, legumes, grains, rice, and they're looking at how that's moving around the world on shipping containers, right? There's another index for the oil futures or whatever. You could look at different indices for that. Brent food prices.
What was that one you were talking about in New York with the World Trade Center? They had a kind of market.
Oh, the commodities
Yeah,
exchange market.
yeah.
Well, they had one there. The biggest one in the US used to be in Chicago. I think now they're just online.
Gotcha.
And
Yeah.
so they just went fully online, I believe. I think that one ended like in 2022 or 20, somewhere around there. They just went fully online. But they did have one at the bottom of the World Trade Center. And they trade commodities there too. So what are commodities besides, what are other commodities? Raise your hand what's a commodity?
Gold, silver,
Okay, gold, silver, okay.
oil.
Oil, right? What else? Wheat, is that a commodity? You can buy it in bushels, right? And so these things aren't just to speculate on. The reason why in Chicago you trade them there is why? Anybody know? For the most part, especially the agricultural product. It was a way for the farmers in the old days to hedge themselves and sell their product ahead of the harvest. Does that make sense? And so they'd sell it and then they'd take delivery. People would actually go and take delivery. That nowadays we have a little more financialization. It's more just trading on paper for paper's sake. Oh, I have this much oil or gold, but do you really? It's on a paper certificate that you'll never cash or what? Do you see the difference? Right, but on the commodities exchange, you can actually take delivery of these things. So bushels of wheat, barrels of oil, or pork belly. You could buy. What's pork belly? Did I mention this one? What's pork belly?
Bacon.
Bacon. So you could buy bacon in bulk. How about this one? I have to write the acronym down. Of course. So FCOC. FCOJ. This one's no good. Guess that one for a point. It's not that hard. What's the last two? Yeah.
So like 4 to something orange juice.
All right, that's close. Frozen concentrated orange.
Right, the Minute Maid.
Yeah, the Minute Maid things. You've seen those?
Yeah.
They sell those in the stock market and the exchange, but they'll sell like pallets of it, and it's like boiled down orange juice. And then you could either add water to it if you're like a big manufacturer or whatever, or just sell the frozen things like Minute Maid. Isn't that interesting? So all these different things. All right. Anyways, again, we're talking about material factors that could change. And so what affects these things? So like if there's a watch the movie again. It's not too PC anymore. It's with Eddie Murphy, Trading Places. Did I recommend that one?
Yeah.
Anybody seen that? It's a comedy. You can probably watch it on Tubi or whatever for free now. I think they have a lot of those old movies. But it'll show you how the commodities traders were doing their thing in those places. And again, so yeah. So anyway, but yeah, so so the reason I mentioned the movie is because in the movie they're gambling on or investing on the future price of orange juice, right? Of these frozen concentrated orange juice stocks. And they're looking at the orange harvest in Florida, actually, because Florida is one of the biggest producers here in the US. And so they're looking at the harvest for data. Oh, how did the harvest do? If the harvest was small because there was a longer winter, then the price of orange juice is going to do what? Small harvest, then price goes up, right? Because there's less juice, more demand, maybe there's 300 million Americans or more. So the price of juice goes up. If you want juice, it's gonna cost you. If not, go have some milk or something else. All right. And same thing now with the cattle. Did you notice that beef prices are up? Why are beef prices up? Anybody? Again, these are material factors. Why are beef prices up so high? Right now, I don't know, what was the last time I went to go buy a steak? I like steak, if you could tell. I'm a good eater. I went to the store and it was like 20 pounds for like what is that I usually buy, either a New York strip or porterhouse or something like that. I like the nice thick cuts, and they were like $23 a pound. Normally it's like $9.99 a pound. I'm cheap, so I always look for like the $9.99 or $12.99. Nowhere to be found. So it's basically double the price. And why is that the case? Why is beef at like double the normal price?
Maybe it's like they had a infection among cow.
There is no infection, but good one, good guess. Yeah, you guys. Less cows. Yep, we're at the all-time lowest stock of beef and cattle in the US. So for whatever reason, yeah.
I was gonna say, like, I know in Europe, I don't know if it's bad in America, but they're pretty much like environmental restriction on farmers, like, especially cattle and stuff like that.
Well, and then in the US, they're also doing a thing where I lived in North Carolina once. I don't even know if I should go into this conversation because it's kind of pointless, but I lived in North Carolina once, and one of my neighbors owned cattle. And there was actually a cow farm across the street from me too, but it wasn't that farm. He had a farm a little bit up the road, and I'd been to that one too. I actually went there and stopped once, and I was with my younger son, or my oldest son, who was the only one at the time, and we were like teasing the cows from the fence, and then they looked like they were going to stampede us. Like I got a couple of them mad, and they all just started staring at me, and I just said, "Let's get in the car. Let's get out of here. This is creepy." So because the only thing standing between us was a little wire fence. And it was like 100 cows there. And anyways, he told me that he would sell that his family would sell the cows for about 3,000. And so I was doing the math, and I was like, that's like about $3 a pound or $1 a pound or something. I was like, they're kind of ripping you off at the supermarkets. Because they sell it for like $9.99, $13 a pound. So I'm like, that's maybe you got to negotiate a little harder with them, especially since they were good cows. They're like out there on the field. You know, it's not like some sweatshop cow or something where we've heard the stories or whatever. But anyways, but it's a material factor, an issue there. And so we're at the all-time low. They're trying to repopulate the stock now, especially in Texas. And also Brazil as well. Brazil ships a lot of beef here. Argentina is another big beef manufacturer. China is actually the world's #1 beef manufacturer by volume. Did you guys know that? I'm pretty sure they're #1. Fact check me on that. I think it's the China, US, and Argentina, or maybe Brazil and Argentina. Argentina is known for having like the best beef, and then the US I don't think is far behind. They could be tied. Well, we do funny things to our beefs and stuff, and like with all the GMO stuff, everybody's kind of like, well, what are they doing over there now? You know. But anyways, they're trying to restock that, but it's going to take at least 5 to 6 years, they said, for the prices to normalize. So anybody into beef or vegan? Anybody vegan in here or vegetarian? No? All right, no vegetarians. So okay, so I was gonna say it's a good time to be, I guess, vegetarian or not eat cows, but so that might be the issue now when you see the prices up. All right, so it's a supply and demand issue for whatever reason. And so here are some good quantitative indicators that deal with these material factors, such as like the Purchasing Managers Index. That's another one. It looks at different heads of companies here in the U.S., the large Fortune 100 companies. And it's a survey done, an economic survey. Economists will call them up and they'll ask, and it's voluntary information that they'll divulge. So the accuracy there, but it's a rough estimate when you put it all together. And it says, how much are you guys buying in terms of raw materials for your inputs into your products? And they get an estimate of, is the economy is it growing? Or are these purchasing managers pulling back and expecting to sell less? Does this make sense? So these are different indicators that you can see to kind of not predict the future because it doesn't work, but to kind of get an idea of what's coming next. It's hard to time the market and predict. Then there's census data on new home sales you could look at. You could also look at not only what's been sold, but what's the availability of mortgage credit as well. So who's buying? Is there a supply of credit? Are there buyers? And you can start to see, is there a demand? So look at all these things. It's a good cheat sheet along with the Baltic Dry as well. Are we going too long? When did we end here? 45. 45, oh, we got time. Right. Yeah, we got good. Sometimes I feel like I've been talking for a while already. I don't know. I'm just getting used to the semester. I had a long summer, I guess, and it got me a little soft. So I got to get my stamina back here in the classroom. So let's see. So ideational markets. So there's a economists, again, the mainstream economists, they kind of see the world as just being run through numbers and that you could try to predict things. And so they spend a lot of time on that. Other economists actually and financiers that are a little more successful, even John Maynard Keynes, which I may talk about a bit in this course as well, and people like George Soros, who may be notorious in politics, but he was a great, I think he's retired now or semi-retired now. He's a great investor and especially in the Forex markets. And so he was great at timing markets and understanding that ideas are actually more important than material factors when it comes to markets. So he would look at things like business confidence, psychological factors, optimism, pessimism, and the sort of sentiment and the risk, this fear of risk. So he's looking at that. Keynes also was one of the first to start to do this as well. Okay? Make sense? So it's a different idea. Keynes was also quite rich in investing. So I like to focus on the economists that actually made money. So like sometimes like others don't. I won't mention the ones that don't right now. Let's just keep it let's keep it positive here today. All right. So what else do we have? Factors affecting business cycles. Also, you have non-market factors. So these factors outside of the markets are going to be things like economic policy, trade agreements, capital controls. The Fed interest rate policy is another one. IMF and World Bank lending conditions could affect the country. What trade agreements have we been doing lately? What's been going on with trade? Yeah.
Like could it be like international even?
Yeah.
Tariffs.
Lots of tariffs, right?
Yeah, lots of tariffs going on. I mean, just certain military arms deals, stuff like that.
Okay.
Stuff like certain aid, stuff like that.
Now, what's the logic of the tariffs that the Trump administration is putting? What's that going to do? Let's try to think this through as well.
Bring industry back to America.
Bring industry back to America. Okay, very good. And I think we do need that for sure. But what's the immediate effect of trade? Is it going to cause inflation of the tariffs? Inflation or deflation? I just want you to know what tariffs do initially. Do they cause inflation or deflation?
Inflation,
Okay, very good. Why?
it costs more money, I think, to like bring the stuff over here, so they have to
up the prices.
Right, so you might create supply shortages immediately, and that'll raise the price of certain goods that could do that. And we're also dealing with inflation, so while there, but is it a necessary evil, I guess, to do the tariffs at this point? These are policy questions that you should also try to think critically about. Okay, as not only business people, business students of business in the general sense, not just at BSU, but just students of business for the rest of your lives, since you decided to, you're stuck. Like there's a Pandora's box you open. You decided to join a business school, so you're gonna have to continue to grapple with this, unless you just ignore it. But you kind of have the lexicon, and you're gonna read about it, and hopefully it interests you, and maybe you could even make a difference or something. I don't know. So how does that make sense? So again, a lot of the things that we see from the Trump administration, for better or worse, it is kind of like off the cuff, like let's just do this, let's just do that, and that's okay, I guess. But it's not always well thought out. But I mean, the decisions before that, were those well thought out that kind of got us here anyway? Probably not either. All right, so just maybe get less media attention or whatever. So you take it for what it is. All right, so but nevertheless, trade what was it we were saying? I'm losing my that's on the tip of my tongue now.
Tariffs.
The tariffs, yes, the tariffs are inflationary inherently, especially early on. And then once the businesses come here, it might be inflationary as well, because especially since a lot of the businesses like Nike and whatever are taking advantage of cheap labor abroad, right? Not only cheap labor, but cheap environmental regulation, environmental requirements, maybe easier tax systems or breaks that they're getting. So it might raise prices here as well, but at least you will get the jobs. And we're kind of dealing with inflation anyway. So there's always a give and take, and there's always a catch. And I just want you guys to think critically as you put it together. We're also losing, by not having the manufacturing base in the US, you're also losing a lot of the manufacturing know-how and the capability to go forward. So that's another thing that you lose, right? Does that make sense? And we'll probably talk about that more in different areas as well. All right, but these are ideas that are the focus here is more on, I just gave you like a taste of one, but the focus here is that these are non-market factors. So like trade policy, that's, it's a legal thing, it's a political thing. It has nothing really to do with the market itself. It becomes part of the market, it affects markets, but it's not from the regular ebbs and flows of the market just functioning normally. But you shouldn't see the market as something out there. The market is really everything. But you could kind of delineate here, what goes there, and organize things. But again, that's one of the fallacies in mainstream economics, and why business is a little bit better as a study, because you're kind of looking at marketing, you're looking at HR, you're looking at operations, you're looking at strategy, international business, and so you're getting a more of a 360 view as opposed to just calculus. Right, and then other non-market factors are going to be things like strikes. Those happen from time to time. Wars, climate, so climate change, whether you believe in it or not, or catastrophes, and also health catastrophes in the pandemic. All these different things affect things. So it's not just climate change, but like I mentioned before, the frozen concentrated orange juice, if a crop freezes or doesn't produce, there you go. All right, so in terms of what this all sort of ties back to, again, the general theory, 1936, John Maynard Keynes. And so where you start to see this, it comes from the idea of these non-market factors, these ideational factors that markets have. And you have things on investor confidence. So investor confidence, this means, unfortunately, that not only that slumps, right, and depressions are exaggerated in degree. So they sometimes go on a little bit longer than necessary. And it's because there's a lot of political and social factors at play, right? So at what time is it okay to get back into the market if there's a big crisis? It just depends on the market itself, right? It depends. Are we talking about the Spanish Salamancans in the 355?
We had
in the
Kinda
next
just-
week or two.
Yeah, I was gonna say, we're really kind of just starting it.
So in that class, there's there's 1 week where we look at what's value, and what are prices? How do we get to prices? And to give you a spoiler, because they're probably not gonna take it as they're graduating.
The sell Malkins into gold.
Right.
Exactly, okay.
And so in terms of prices, how do you get to prices? And it's just whatever the market, whatever you could fetch out there. There is no like nothing that anchors it down in a sense. You may spend a lot of time and effort, maybe it costs someone $100 to make this cup, but in the market, are you gonna get $100 for this cup realistically? I spent $100 in labor material. I bought, a machine. I pulled the lever, $100. That's the cost for me to break even. Does the market care? No. How about if I go back, you won't get this again in the 355, we may get to this. How about tulips in Amsterdam? What was the price of a tulip in Amsterdam? In the 16 and 1700s. All right, so they went up to 3 times an annual wage. So they were like a tulip bulb, a seed was going for $36,000, $50,000 in a tulip mania. All right, and then it crashed because people were buying these things on credit and it was an investment. What's a similar investment today, you'd say? Like a wacky investment. Beanie babies or cryptocurrencies, a lot of them. There's really no value underneath it. That's an important one. All right, so creative destruction, boom and bust cycle. We still have good time, right? I'm just not. When is the class end now?
2 minutes.
2 minutes? All right, so we'll have to pick this. We'll have to pick this up. So we're doing good though. We're doing good. We'll continue it. It's actually a good cutting point because we're kind of like segueing. So the method to my madness is here. I gotta just readjust here. I'm getting back on the saddle for the semester. So, okay, so my second lecture, here we go. All right, so I'll see y'all Monday. Remember, purchase those simulations and start working on it with your team. Go on the site and connect with your teammates as well. Start to collaborate a bit.
Anybody from group 3?
I'm in group 3.
Group 3, yeah, group 10.
Thank you.
On the sign up sheet, is it 18 and no, just I have to sign up.
What's that?
Is there a certain amount of people per group or can I just